Ladies and gentlemen, welcome back to Boss Economics World, the only place where we call out the economic clown show for what it is, pure, unadulterated chaos. I'm your host, the guy who's been screaming into the void about stagflation, tariffs, and Fed flip-flops since before it was cool. And oh boy, do we have a spicy economic dumpster fire to unpack today. Buckle up, because we're diving headfirst into the Federal Reserve's latest tightrope walk, the Trump tariff circus, and, spoiler alert, how the government's economic mismanagement is setting us up for a recession so bad, it'll make the Great Depression look like a summer picnic. Let's get into it. So, here's the deal, folks. According to a fresh Bloomberg news survey, I know, Bloomberg, the outlet that loves central bankers more than central bankers love their own jargon, economists are betting the Federal Reserve will keep interest rates steady at 4.25% to 4.5% through the first half of the year. Then, maybe, possibly, if the stars align and Jerome Powell gets a good night's sleep, we'll see 2 measly quarter-point rate cuts starting in September. 2. That's it. Meanwhile, inflation is running hot, growth is slowing, and the Fed is sitting there twiddling its thumbs like a teenager waiting for their Uber Eats delivery. What is this, monetary policy or a bad rom-com? Let's break this down for the regular folks out there, because, trust me, the Fed doesn't care about explaining this to you. High interest rates mean borrowing money is expensive. Expensive borrowing means businesses can't expand, consumers can't buy homes, and the economy grinds to a halt. But here's the kicker, inflation is still way above the Fed's 2% target. Core inflation, which strips out volatile food and energy prices, is expected to stay elevated, according to the Bloomberg survey. So, we've got a classic catch-22, lower rates to boost growth, and inflation goes through the roof, keep rates high, and growth stalls out. Welcome to stagflation, baby. And let's not forget the Fed's own projections. They're expecting slower growth and higher inflation in their upcoming forecasts. Translation. They're admitting the economy is in trouble, but their solution is, drumroll, please, to do nothing. Jerome Powell literally said, and I quote, "The costs of being cautious are very, very low." Low for who, Jerry? Not for the millions of Americans drowning in credit card debt, not for the small businesses crushed by borrowing costs, and definitely not for the workers whose wages are being eaten alive by inflation. But hey, as long as Wall Street's happy, right? Now, let's talk about the elephant in the room, or should I say, the orange-haired reality TV star turned economic policymaker. That's right, folks, Donald Trump's back, and he's brought his trusty tariffs with him. For those of you who don't speak trade war, tariffs are taxes on imported goods, which Trump loves because they sound tough and America first. But here's the problem, they're a wrecking ball to the economy, and the Bloomberg survey proves it. Economists are slashing their growth forecasts and jacking up their inflation predictions, all because of Trump's tariff threats against China, Canada, Mexico, you name it. And the best part? He can't even make up his mind. One day it's, tariffs on everything, the next it's, maybe not, who knows. Financial markets are rattled, businesses are paralyzed, and consumers are stuck paying higher prices. Bravo, Donnie, truly a masterclass in economic mismanagement. Let's get real here. Tariffs sound great on paper if you're trying to protect domestic industries, but in practice, they're a disaster. Just look at the data. According to a 2023 report from the Tax Foundation, Trump's previous tariffs on Chinese goods cost American consumers and businesses over $80 billion in higher prices. And guess what? Those tariffs didn't even bring back the manufacturing jobs Trump promised. Manufacturing employment barely budged, according to Bureau of Labor Statistics data. Instead, they fueled inflation, disrupted supply chains, and pissed off our biggest trading partners, who retaliated with tariffs of their own. Soybean farmers in the Midwest. Crushed. Auto manufacturers. Hammered. And now, Trump's doubling down, threatening even broader tariffs. Moody's Analytics estimates that his latest proposals could shave 1.3% off U.S. GDP by 2025. That's not winning, folks, that's economic self-sabotage. And here's the kicker. Tariffs are inflationary. When you slap a tax on imports, companies pass those costs on to consumers. Just look at the numbers, the Consumer Price Index, CPI, has been stubbornly high, with inflation running at 3.2% year-over-year as of February 2024, according to the latest Bureau of Labor Statistics data. Core inflation, which the Fed loves to obsess over, is even worse at 3.8%. And now, with Trump's tariff threats, nearly two-thirds of economists in the Bloomberg survey are forecasting higher inflation. So, while the Fed's trying to cool things down with high interest rates, Trump's out here pouring gasoline on the fire. Genius. Now, let's talk about the word nobody wants to say out loud, stagflation. For the uninitiated, stagflation is when the economy slows down, unemployment rises, and inflation stays high. It's the economic equivalent of getting food poisoning and the flu at the same time. And guess what? Thanks to the Fed's inaction and Trump's tariff tantrums, we're staring it right in the face. Don't believe me? Just listen to Scott Anderson, chief U.S. economist at BMO Capital Markets, who said, and I quote, "The Fed is in a very tough spot right now, facing a more stagflationary outlook even as core inflation remains well above its medium-term target." Translation: we're screwed, folks. Here's the data to back it up. U.S. GDP growth slowed to an annualized rate of 1.3% in the first quarter of 2024, according to the Bureau of Economic Analysis. That's barely keeping its head above water. Meanwhile, the unemployment rate, while still low at 4.1% as of March 2024, is starting to tick up, with job growth slowing significantly. Only 114,000 jobs were added in February, per the BLS, well below expectations. And inflation? Still stubbornly high, as we've already covered. This is textbook stagflation territory, and the Fed's response is, to wait. Are you kidding me? Let's not forget the Fed's other genius move, quantitative tightening, QT. For those of you not fluent in Fed speak, QT is when the Fed shrinks its balance sheet by selling off assets, which sucks money out of the economy and tightens financial conditions even further. According to the Bloomberg survey, 11% of economists expect the Fed to slow down QT at their next meeting, and 41% think it'll happen sometime in Q2. Slowing down QT might sound like a good idea, less tightening, more money in the system, but it's a band-aid on a bullet wound. The Fed's already behind the curve, and now they're stuck in this weird limbo where they can't cut rates without fueling inflation, but they can't keep tightening without tanking growth. It's a masterclass in indecision, brought to you by the same people who brought you transitory inflation. Remember that gem? And now, folks, let's talk about the real villain in this story, the government. Because let's be honest, the Fed wouldn't be in this mess if the government hadn't spent the last decade treating the economy like a piñata. From Trump's tariff tantrums to Biden's trillion-dollar spending sprees, our fearless leaders have done everything in their power to make sure the economy crashes and burns. And the data doesn't lie, nearly 3/4 of economists in the Bloomberg survey said they now see weaker growth in 2025, thanks to Trump's policies. 2/3 are forecasting higher inflation. This isn't a policy debate, folks, this is a policy disaster. Let's start with fiscal policy. The U.S. national debt is now over $34 trillion, according to the Treasury Department, and the Congressional Budget Office projects will be adding another $1.5 trillion to the deficit in 2024 alone. Why? Because the government can't stop spending money it doesn't have. Biden's Inflation Reduction Act. More like the Inflation Acceleration Act, am I right? And Trump's not exactly innocent here. His tax cuts in 2017 added $1.9 trillion to the deficit, according to the CBO, with almost no measurable boost to long-term growth. Meanwhile, both parties refuse to touch entitlement spending, which accounts for over 60% of the federal budget. It's like watching two drunk drivers arguing over who gets to crash the car first. And then there's the regulatory mess. Businesses are drowning in red tape, from environmental regulations to labor laws, all while facing higher borrowing costs and tariff uncertainty. Just look at the latest National Federation of Independent Business, NFIB, Small Business Optimism Index, which hit a 12-month low in February 2024. Small businesses, the backbone of the U.S. economy, are getting crushed, and the government's response is, crickets. No wonder 73% of economists in the Bloomberg survey are slashing their growth forecasts. This isn't just mismanagement, folks, this is malpractice. So, here's the bottom line, folks. The Fed's asleep at the wheel, Trump's playing tariff roulette, and the government spending us into oblivion. The result? A stagflationary nightmare that's going to hit regular Americans the hardest. Higher prices, slower growth, and more uncertainty, and all because our leaders can't get their act together. My advice? Start saving now, because when this recession hits, and trust me, it's coming, it's going to be a doozy. And hey, maybe it's time we start holding these clowns accountable, huh? Until next time, this is Boss Economics World, keeping it real while the economy goes off the rails. See you in the bread lines, folks.